Making new highs in the bond market once again for 2022. Live from New York City for our audience worldwide. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York, we begin with the big issue, counting down to Chair Powell.
Chairman Powell.
Jay Powell.
Looking to hear from Chair Powell.
For right now, the Fed is kind of driving the ship.
And reality is Powell is extremely hawkish.
We have the all-important Fed meeting.
Powell might have to thread the needle and try to sort of talk the market away from the ledge.
Investors have to remember the Fed does not care about the stock market.
The hot core CPI print that we saw on Tuesday.
The Fed has a lot of work ahead of itself.
We are expecting 75
basis points.
The Fed isn't going to blink.
The right thing to do, again, is to stamp out inflation.
Credibility is based on that fact alone.
There clearly isn't going to be a pivot anytime soon.
There will be, of course, a lot of focus, not just on the move itself, but on the message that accompanies it.
Joining us now is Crossmark's Victoria Fernandez and JP Morgan Asset Management's Bob Michael. To the both of you, thanks for being with us. And let's start with this bond market. A 10-year at 3.55, a 2-year approaching 4%. Can I get your view on this, Victoria? How much of a buy is that?
Well, look, I mean, as you're speaking to someone that actually manages some taxable fixed income, I think you have an opportunity here. We look, and you've been talking all morning about the percentage of S&P stocks that are, their dividend yield is compared to the 2-year Treasury. I think there's only 16% that are above that. So I think you do have a buying opportunity. We're actually buying in the fixed income markets, but now we're buying longer duration. We've been short duration for years. And so we've been lengthening that duration, going out the yield curve, but really kind of doing a barbell approach, Jonathan. We like the yield you're getting on the 2-year, but we want to go further out the curve and extend that duration. So doing a barbell there. I think you do have a little bit of an opportunity. The TINA component is not completely in play at this point because there are other opportunities. And I think you can also leave a little bit more in cash than you have previously because we are going to have some volatility in the equity markets, and that gives you a little bit of fodder when the market comes back down.
Bob Michael, do you like a 10-year at 3.55, 3.56?
Not in the least. If I look what the Fed's done so far, let's remember they've raised rates 225 basis points. We think they have more than that to go. They have at least another 250 basis points to go. So we're less than halfway through. The market's even pricing in another 225 basis points, so saying they're halfway there. I don't recall in what textbook it says it makes sense to fight the Fed.
What is fighting the Fed in credit then, right now, Bob? What about credit? Where does that leave things?
Well, credit, I have to say, is a point of a lot of debate internally. Our high yield team, bless their souls, looks at the high yield market yielding over 8.5%. They look at default rates hovering close to zero. They see default rates, in a recession going up to 3 or 4%. And feel that at a 500 basis point spread, you're compensated for that. And we're saying wait until we get into a recession. A reasonable spread level for recession is 750 basis points. We think at a minimum, the Treasury curve will be at about 4.5%. That's a 12% yield with credit spread and where the Treasury curve is. That's substantially above the 8.5% now. So there's a lot of impatience in the market to take advantage of the repricing. We're not even in the recession yet. Let's wait till we get there.
Victoria, would you agree with that? Wait, be patient here.
I think to an extent you need to be patient, but I would say instead you need to be choosy in what you're doing. We're not investing in high yield. We don't think you should be taking that risk at this time because we do think if you're going to have earnings expectations pulled down, whether you go into a recession this year or next year, do you want to be in that high yield credit space? We look at investment grade credit, and I think you've got some better opportunities in those triple B names where spreads are out a little bit on the year, but not significantly. You're still not at the high spreads that you've seen in other crisis or other times like this. And so I think you have some opportunities there where you can build in, because the credit market is telling you, yes, yields are high, but I disagree. I don't think we're going to go double where we are right now. I think we're going to go maybe a little bit higher. Then when we hit slower growth, hit possible recessions, we're going to see yields come back down. And that's where you get the advantage of the yield curve along with a 4% coupon.
Just getting some breaking news as well, some headlines crossing the Bloomberg. Let's get to Abigail Doolittle on those lines. Hey, Abby.
Hey, John. Well, we do have breaking news, and we have breaking news on two major companies, starting off with JP Morgan. Jamie Dimon, the CEO of JP Morgan, in prepared comments, he has criticized higher capital requirements ahead of hearings. Of course, he and some of the other CEOs from big banks heading to Washington this week to testify on Capitol Hill in both the House and the Senate. This, of course, as the fall midterm election season heats up and a stack of proposed banking bills await potential action. They, of course, suspended the share buybacks back in July to quickly meet higher capital requirements tied to a harsher stress test result and previously flagged increase to its buffer to systemic importance. So again, Jamie Dimon is criticizing, blasting, in fact, those higher capital requirements ahead of earnings, ahead of those hearings. As for Microsoft, that's the other piece of breaking news that we have right now. They have raised their quarterly dividend 10% to 68 cents per share. The stock not really doing all that much, and I should say in JP Morgan, that stock not reacting to those headlines all that much. But given the fact that, John, as you know, that they did pre-announce, I think a couple of weeks ago, maybe it was a month and a half ago on Forex, this is probably a positive for investors, the fact that Microsoft is raising its dividend by 9.7% to 68 cents a share. Right now, that stock down about 0.5%.
Abby, thank you. About 24 minutes away from the open, and bell equity futures are lower by 6 or 0.7%. This market looked for another outsized rate hike from this Federal Reserve. Mike McKee joining us now for more. Hey, Mike.
Hey, John. Well, it's kind of interesting because the rate hike is probably going to be the least important aspect of the meeting since it's pretty much priced in already. What really is going to get people's attention is the summary of economic projections, what the Fed thinks is going to happen to the economy over the next couple of years. Right now, they've been looking at a 1% growth rate, 1.7% this year and next year, and then it goes up just a tiny bit, but all of those growth rates below what potential is. Look for that to change. Unemployment, look for that to go up. They're going to have to predict where they think unemployment is given where they think rates are going to be, and then look for the PCE headline to rise as well. Core, they're pretty much on target, but PCE headline is going to tell a lot to the markets about what they think is going to happen, which brings us to, of course, the dot plot. What do they think they're going to do about rates? The high white line there is what the market thinks the Fed should do. Expect the 2022 and 2023 dots to move higher, to match that with the median, but then do not look for it to come down the way the market thinks it's going to. The Fed's been very clear about higher for longer, and so then we get to Jay Powell's news conference where he's expected to repeat that remark by saying that they are purposefully moving their rates to a level that will be restrictive, sufficiently restrictive, and that will require maintaining a restrictive policy stance for some time. Powell expected to be on message and trying not to give anybody a reason to think that the Fed might pivot anytime soon. Now, as Bob Michael points out, the markets have priced in the Fed going as high as 4.5%, maybe a little bit higher at the moment, but they still think there will be a pivot in the latter half of 2023.
Mike McKee, thank you. Bob Michael loves to give you a question to ask in the news conference, so let's ask him that now. Bob, what would you like Mike to ask in this presser tomorrow?
I think he should push the chair on the balance sheet runoff on quantitative tightening. Every meeting, there's some debate about how high they're going to hike rates, and even the market's pricing in a doubling from here, which is dramatic change from the start of the year. Why are we stopped at $95 billion a month in balance sheet runoff? Why don't they put that live every meeting and perhaps ramp that up to $120 billion per month, which is the inverse of what they were expanding a couple of years ago. So I think there needs to be some questioning about their policy on balance sheet runoff.
Mike, your thoughts on that? Just to get your reaction to it, Mike. Why haven't we heard much on it?
Well, they're trying to make it something that runs in the background and doesn't influence monetary policy all that much. And what's interesting is that a lot of people in the markets are suggesting the Fed might be going too far too fast with balance sheet reduction, that there's a liquidity problem ginning up in the markets, and that they may have to stop sooner. So it would be interesting to see what he would say to your question, Bob, because it's kind of the opposite of the question he might be expecting.
Bob Michael and Victoria Fernandez are going to stick with us. Mike McKee, thank you, buddy, as always. Futures lower on the S&P 500 with your movers. Here's Abby.
Hey, John. Well, let's reiterate that breaking news that we had relative to both JP Morgan and Microsoft. We have JP Morgan at this point down just modestly, down a little bit more than 0.5%. This, of course, after they did JP Morgan's Jamie Dimon, CEO of JP Morgan, said in prepared remarks criticizing the harsher capital requirements. This, of course, before heading down to Washington this week to testify before both the House and the Senate. Back in July, they temporarily suspended their buybacks to quickly meet stricter capital requirements. Microsoft down 0.6% despite raising their quarterly dividend by nearly 10%. That stock right now down about 0.6%, and they did raise it to about 68 cents per share. Ford is down sharply, down 5% on disappointing earnings. And then Norwegian Cruise Line up about 3.3%. This is, of course, on an upgrade, a more positive view there. So we have a little bit of the reopening flare helping out some of those cruise line operators, John, and the travel trade.
Abby, thank you. Coming up on this program, corporate America feeling the inflation pinch.
The risks are certainly on the downside in terms of earnings expectations. They're still too high. It's really the margin story, I think, that has yet to weaken in any meaningful way. I think that will bring earnings down.
Ford, the latest company with a big warning. That conversation up next.
Risks are certainly on the downside in terms of earnings expectations. They're still too high. But having said that, I don't expect to see a very significant downturn in profits. Private sector balance sheets are actually quite healthy. We still have reasonably solid revenues because nominal GDP is actually quite strong. It's really the margin story, I think, that has yet to weaken in any meaningful way. I think that will bring earnings down.
Another warning from corporate America. This time it's Ford, bringing down its earnings estimates and writing in a statement the following. Inflation-related supplier costs during the third quarter will run about $1 billion higher than originally expected. A shortage of key components can disrupt Ford's production of vehicles. Kaylee Lyons has more. Hey, Kaylee.
Hey, John. Yeah, a big warning from Ford. They say that larger than expected $1 billion input on the cost side means that their adjusted EBIT is only going to be about $1.4 to $1.7 billion. That is less than half what it was a year ago and about half of the quarter reported last go around. And that is why we see the stock down about 5% in early hours. But we know, as you said, that Ford is not alone in issuing warnings of this kind recently. A number of big household names have done the same. FedEx, for example, issuing a profit warning late last week, citing a decline in global volumes due to the worsening macroeconomic trends. You had GE warning supply chain challenges will have a negative impact on profits. A similar story when it comes to the steel makers. That list goes on. The common theme is one kind of just stagflation, where growth is slowing, weighing on demand, and inflation is high, meaning higher input costs and pressure on margins. That's not a great recipe for corporate America and corporate profits, which is why we have seen earnings revisions for U.S. companies negative now for 15 weeks straight, meaning the downgrades are outnumbering the upgrades. But as you and I were talking about yesterday, as we were just hearing from Peter Oppenheimer at Goldman Sachs, that what we've heard from the likes of Mike Wilson at Morgan Stanley is that these still are too high, those earnings expectations. They expect more downward revisions to come, and they think the equity market will go down along with that, John.
Kaylee Lyons, thank you. Victoria Fernandez, Bob Michael back with us. Victoria, first to you. The concerns around earnings, do you share them?
I do share them. And, you know, Jonathan, we talk frequently about kind of what our expectations are. And we actually thought we were going to see those downgrades come in the second quarter, and we didn't. So we pushed that back and said, OK, that's going to have to hit in the third quarter. As Kaylee showed, we've seen those continually come down, those expectations. But I think we also have to remember, you know, yes, there's concern on margins, but look where margins were in the second quarter. What do we have? 12% margins. That was down from a little over 13 in the first quarter. So margins can come down and still still be solid enough for these companies to continue to do what they're doing, to continue with CapEx, to maintain their workforce, which is going to continue to be supportive for consumption, for consumers, for workers. So yes, I think we're seeing a slowdown. Yes, I expect the equity market to react to that, but I don't think we're going to fall off a cliff when it comes to earnings. And when you look at some of the notices that came out, Ford you mentioned, FedEx you mentioned, but at the same time, look at other companies. UPS came out and said, we don't have this issue. We still see strong demand. Last week at banking conferences, you heard some of these banks come out and say, look, demand is there, consumers are good. So we really have a mixed bag right now, and I think that's why we're going to continue to see volatility, but I think we do need to expect earnings expectations to come down for them to be lower than they were last quarter.
They don't see these issues yet. We've got mortgage rates, Bob, through 6%, maybe approaching 7%, had a massive repricing of real rates. How long before this shows up in the economic data, Bob, economic activity?
Well, I think that's what the Fed is looking for. They do see that they're raising the cost of funding, so it's impacting auto sales, housing, and credit card purchases, but it's coming down from a very high level. And as Victoria said, corporate profit margins are still pretty good. And they put in place 2 years of ultra low cost financing in 2020 and 2021. And you've got a tight labor market. So they've got to pass along that cost. I think the Fed's watching all of this, and I think it's going to cause them to have to go further than even we think in hiking rates to really lean in to this kind of growth.
Is that a 5 handle on Fed funds, Bob?
Well, for now, we're at 4 3/4 is a minimum. So yeah, 5's definitely in the realm of possibility. And one of the things that we've looked at is the Fed has never stopped a hiking cycle with both headline and core inflation above the Fed funds rate. So they've always gotten to a positive real rate.
So Bob, with that in mind, you've got the potential for 5% Fed funds. You've got a base case of a recession. Can you talk to me about the character of that recession? I get a lot of guests on this program, Bob, you've heard them, who talk up short and shallow. If we get one, it will be short, it will be shallow. Do you share that?
No, I don't. I think that you have to step back and say the Fed is fighting a 40-year inflation problem, and they and the other central banks are horribly offside. So they're going to be very aggressive in here. On top of that, we've had 2 years of ultra excessive liquidity at a very low funding rate. So when you have tremendous liquidity, which is costless, it bubbles up and gets leveraged somewhere. And as you raise the cost of funding, certainly as the Fed is doing to that magnitude, something will go pop in the night. We're keeping our eyes out, trying to figure out where that is. But for sure, something's been financed with too much liquidity at too low a cost, and that will pop.
Bob, that sounded like a subtle nod towards the potential of some kind of systemic problem. Is that a fair characterization of your concerns at the moment?
Oh, for sure, it's a concern. I mean, when you take this much liquidity out of the global system after it's been binged on and sloshed everywhere and inflated the price of everything for years, you've got to be careful about it. I'll tell you, at our investment quarterly, there was a divide, and it was very generational. There are those of us who were around in the early 80s who just see a lot of downside. And there's the more, let's call it modern school of thought. Those have been around since the financial crisis that believe MMT will cushion to the downside. We'll wait and see what the central banks think of that.
So, Bob, where do you think the risk is? Just as you look right now, where's the leverage? Because I'm told it's not on corporations or consumer household balance sheets. Is it on the sovereign? Where is it?
No. A lot of stuff got financed in credit. There's a lot of discussion about what's going on in the loan market and a slower credit quality than previously. I think the private capital markets are very opaque. It's there somewhere. It may be in the public markets. But a 2.25% Fed funds rate and looking at the 10-year at 3.6% or wherever it is not leaning into any of that yet, which is why we're so pessimistic about where the Fed funds rate is going.
So, Bob, you get a lot of people who come to you and say, I need to put some money to work to find some income. Are you just pushing them to hold cash-like securities? Is that where you're pushing towards?
You know what, John? In the front end of the curve, we're looking at high quality, short dated cash flows. So we're looking in the securitized space, we're looking in the investment grade credit space, and yeah, there are even some short dated high yield cash flows that look bulletproof to us. So we want to lend money to borrowers who have fortress balance sheets and just hide out there, collect somewhere between a 4.5% to 5% yield, and let this wave of inflation and central bank tightening wash over the market, and then see where prices are.
Victoria, I'm not sure if you've run away since Bob started talking, because it all sounds very, very bearish. Can I give you the final word on this?
Well, I'll try to bring a little bit of optimism here, but when we're talking to our clients, I mean, we do think there's areas that they can invest in right now. Obviously, we've talked about fixed income a little bit already this morning. Having that cash flow, that steady cash flow, knowing you have a stated maturity date to get your par value back, we think that's an option, and you can combine that with your equities. Look, we're looking at quality names, quality balance sheets, quality management companies, quality earnings. Combine that with some of the dividend components you have, and even the total cash return, right? Dividends and buybacks, then you can put yourself in a position where even with volatility in the market, even with all the things that we've talked about so far that are headwinds for the market, you still have a little bit of a tailwind to help buffer the volatility that you're going to see. So I think you can do that with your clients, and you'll be well positioned regardless of what the Fed and all the other central banks this week, because we know we're not on an island, right? We saw Sweden Central Bank 100 basis points, a lot more this week. You can be well prepared.
Victoria Fernandez, Bob Michael, to the both of you, thank you. Yields up stateside, yields higher on bonds, yields much higher on gilts in the UK. The Up and About just around the corner. Your morning calls up next. Stocks are lower, down 0.8%. Here are your morning calls. First up, Truist upgrading Norwegian Cruise Lines to a buy, highlighting the company's strengthening booking trends. Barclays downgrading Nike to equal weight, warning that currency headwinds and China weakness could weigh on next week's earnings. And finally, Susquehanna downgrading PayPal to neutral, expecting margins to remain under pressure amid growing macro headwinds. That stock's negative 3%. Coming up, recession or no recession, Alpine's Sarah Hunt making the case for buying US energy stocks. That conversation up next. Equities down 0.8%. 25 seconds away from the opening bell in New York. Good morning to you. Here's the price action. We head south, lower down, negative 0.8% on the S&P. On the Nasdaq, we're down 0.9%. On the Russell, down almost 1 full percentage point. Having a little look at session lows, and at the epicenter of this, it's in the bond market. Let's the opening bell, switch at the board and get to your bond market right now. Yields up 9 basis points. We're now looking at 360 on a 10-year, 358.27. Yields higher by 9 basis points in the US. Over in Germany, yields much higher by 14 basis points. Call it 13 right now on a German 10-year bond. In the gilt market, a 10-year up 17 basis points. This is global. The bond market getting shaken out. Yields absolutely flying. Euro dollar negative 0.6%, 99.63. Got some dollar strength in the mix, and crude is lower by about $1 to $84.82. That's a cross-asset price action with your movers. Here's Abby.
John, well, we are looking at a bearish start, as you were just showing, and all 11 S&P 500 sectors at this point are lower. One of the worst, technology, really being weighed on by Microsoft. This despite the fact that the company just raised its quarterly dividend by almost 10% to 68 cents per share. But as you were just mentioning, yields, that is the story. That 10-year yield rising in an incredible way. And of course, the 2-year yield up for a 9th day in a row, the longest up streak since May of 2018, at its highest level since October of 2007. So, of course, those rising yields making everything else look much more expensive, especially high-growth tech. Ford down 5.5%, pre-announcing to the downside the third quarter EBIT on rising costs. They did maintain the full-year view, but investors not liking another pre-announcement. Royal Caribbean up 1.1% in sympathy with that upgrade at Truist for Norwegian Cruise Line on the better industry bookings. And then finally, John, Wynn Resorts up about 3%. This as Hong Kong signals it wants to end some of the COVID restrictions. China is perhaps going to agree to this, according to some reports. So we have these Macau casino operators higher. Wynn receives about 40% of its revenue from Macau.
Abby, thank you. About a minute and 40 seconds into this, we're negative 0.9% on the S&P. Energy down 0.5%. Materials down 1.4%. Every industry group on my screen right now trading in negative territory. Can I just spend a second or a few seconds going through the bond market worldwide? Treasuries, your 10-year, up 9 basis points, closing in on 360. The 2-year up 4, closing in on 4% at 397. Over to the gilt market in the UK. The 10-year yield up 16 or 17 basis points. The 2-year up by 18 or 19, going into the Bank of England rate decision later this week. The 10-year in Germany, in the bond market, yields up 13 basis points on a 10-year maturity. The front end on 2s up 12. Do you want a snapshot of where Japan last traded on a 10-year? 25 basis points. That's where the cap is. Yield curve control. The BOJ later this week. For how much longer can they keep things there, given what's happening elsewhere? Just a massive bond market shakeout right now that we'll stay on top of. So yields up, equities down by 0.9%. Apple is hiking its prices to combat the strengthening US dollar, writing in a statement the following: as early as October 5th, prices of apps and in-app purchases on the App Store will increase in all territories that use the euro currency, as well as those in 9 other countries. Ed Ludlow has more. Morning, Ed.
Yeah, morning, John. Apple down 0.3%, pairing some of its early decline at the market open, but a drag all the same on the S&P 500 and the Nasdaq 100. It's really important to look at the markets where these price hikes for the App Store and in-app purchases will take place, particularly when you think about the euro area and Japan. In Japan, for example, Apple will raise prices by 30%, 8% of its overseas sales. Important, though, given the yen weakness. What a story that's been in 2022, but also dollar strength broadly against key markets like Europe. If we were worried about this, and we've heard about it before, particularly in the context of the software names, about the impact of currency headwind, then how concerned are we going forward? Because you look across the S&P 500 by sector and the context of sales outside of the United States, this stronger dollar is going to continue being a story for the next 6 months.
Ed, thank you. Apple down about 1/3 early in the session, 3 or 4 minutes in. Ford, the latest with a warning following FedEx last week. With the latest, here's Kelly Lyons. Hey, Kelly.
Yeah, John, warning on inflation and that ultimately those costs are going to be about $1 billion higher than expected, which is taking shares of Ford down about 5% here at the opening bell and dragging down peers as well. The likes of GM, for example, down around 2 percentage points. Tesla a little bit more insulated. It's roughly flat on the day, but now Ford's loss is actually deepening. We're talking about 7%. It expects its adjusted EBIT to be in the range of about $1.4 to $1.7 billion when it reports results next month. So again, this is a pre-announcement. Compare that to what it reported last quarter and in the same period a year ago, in which both of those quarters it earned $3 billion plus. So this is pretty light here for Ford in the third quarter. The good news, though, is if there is any, the full year sales outlook has indeed been held. But on the bad news side, the company also said because of shortages of key parts, its inventory of half-completed vehicles is going to stay elevated at what they guess is around 40 to 45,000 vehicles at the end of the third quarter. It said those largely are high-margin trucks and SUVs, so it's not those high-margin vehicles that you necessarily would want to see here. As for what that means overall for its inventories of raw materials, it is sitting right around a record of $6 billion, John.
Kelly, thank you. That stock is not doing well at all in the last 24 hours. Kelly Lyons there on the latest. Your equity market, we're down 0.8% on the S&P 500. The battle lines drawn on Wall Street. On the one side, Goldman and Morgan Stanley painting a very gloomy picture of shrinking margins and a retest of June lows. On the other hand, Wells Fargo and JP Morgan making up a more constructive group, looking for near-term upside and resilient earnings. For more, it's Taylor Riggs. Hey, Taylor.
John, a lot of the technicals come from breaking through 3,900. We closed yesterday's spot on 3,900. Of course, this morning a little bit below that. So that is when you think about an equity market year to date off about 18%. When you think about the probability of retesting those June lows, that is the setup for the S&P 500 as we head into all of the fundamental conversations as well. Let's start with the bullish side. We've talked a lot about this. JP Morgan, earnings revisions may be bottoming. There's also been some low investor position. I've heard a lot about still a lot of cash on the sidelines waiting for that better entry point. The bottom of this, John, I know declining inflation views, peak inflation has been sort of a huge bad call at every sort of month this year. But nonetheless, that is sort of that bullish picture that represents the view of JP Morgan.
I put out a JP Morgan quote yesterday, you know, and just said, guess who?
Oh, no.
And everyone knew.
Everyone knew.
Everyone just replied Marco.
I know. Well, but so let's take the flip side of that, John. This is going to get a little sticky with the math. I'll try to be quick here. You think about sort of Mike Wilson at Morgan Stanley saying the equity risk premium, that's what we're showing here, way too low, with a 10-year yield that approaches 3.50, a 2-year that approaches 4. So you have to fix the front end of that equation, an earnings yield. Either earnings go up or price goes down. I think the focus has been on the denominator of that earnings yield. That price has to go down to get that equity risk premium back up to fair value.
Super, super smart. Taylor, as always, looking forward to the close a little bit later. Thank you. Sarah Hunt of Alpine Woods laying out her calls into year end right in the following. We have not given up on some of the larger tech names like Microsoft or Google. We continue to like energy and the US. A recession will hurt the energy call, but it will not be as negatively affected as the rest of the world. Sarah, I'm pleased to say, joined us right now. Sarah, let's start with that tech call. We just had Bob Michael at JP Morgan join us about 20 minutes ago, saying that in a minimum this Fed gets to 475 and it may well have a 5 handle or higher. What does that mean for those tech calls?
Well, I think the biggest problem for technology is both the companies that don't have a lot of earnings, but also I think that we still think of technology in a basket that doesn't include staples. And I think that the argument that we've been making is that there are a lot of technology names that are really more like staples. And so you tend to see those stocks performing not so badly into slower economic news because people have to have their phones and they have to have their computers. So it's not quite the same as some of the more esoteric technology names where that's more of something that people want as opposed to something that people need.
Can we approach the valuation concern, though, with a 2-year yield closing in on 4%? Yields up again today, and it's not just a local domestic US story, it's a global one. We're seeing big shifts in the UK, big shifts in the German bond market as well. Do yields need to stop going up to make this tech trade work, or do they need to go back down?
I think they need to stop going up, and I think the problem right now is that people don't know where that is yet. And I think that this is where we're looking for some commentary on what's going to happen this week. But in the end, I think that the June rally, that the expectation was that rates were not only going to stop going up, but they were going to start coming down next year. You know, Chairman Powell put the kibosh on that at Jackson Hole. So I think what you really need to see is some sort of stabilization and an understanding that yields have either flattened out or peaked is a hard word because there's been so much volatility. But I definitely think that you want to see things stop going up before that valuation becomes something that you can deal with better. I don't think that they have to come down.
I'm looking at a risk-free 4% in the bond market in treasuries. Sarah, what do the energy names offer me in comparison? What's the competition like now?
I think on the energy names, I'm not looking at it necessarily as a competition on the dividend yield, as I am looking at what's going on in the world. And part of the inflation that we're trying to contain with monetary policy is really a supply crunch. And that supply crunch is because we've had globally a lack of investment in energy. So I think that you've got some growth longer term there. And that's where, you know, you have to look for growth in an environment where the rest of the world or the economies are slowing down. And I think on the energy side, you've got some possibilities, and you've also got the transition away from fossil fuels that is not going to be as fast as people think it is. So I think you've got some possibilities in those arenas. And I think that's one of the reasons that we like energy.
I was looking at some of the investment numbers. Just the capex, $700 billion in 2014, $300 billion in 2021. That was oil and gas investments and how they've declined. Amin Nasser of Saudi Aramco said the conflict in Ukraine has certainly intensified the effects of the energy crisis, but it's not the root cause. Sadly, even if the conflict stopped today, as we all wish, the crisis would not end. Sarah, is that what you're thinking about, these long-term dynamics beyond maybe a downturn in the economy?
Absolutely, because if you look at what's gone on with energy in the last decade, you've had this move to the idea that we were going to get rid of fossil fuels and they started to be treated poorly, and so people did not want to invest in them. I think the problem is that that transition is a lot longer and more difficult than people think. I mean, if you look at California saying you need to have an EV but don't charge it because we have problems with the grid, I think there's a longer tail on that, and that lack of investment is really creating a supply problem. So even when you have fluctuating demand, the underlying need for the infrastructure that basically powers the entire world is still there.
Last time we spoke, you liked Devon, you liked Chevron. Are they still the two top picks?
We still like those on the E&P space. We also like things in the natural gas space. We like Chart Industries because they are a supplier into the LNG industry. I think LNG is going to continue to be important. I think that's part of your transition right there. But I think that you still have to look at this whole base and say, we are going to need a lot of these products for a longer period of time.
Sarah Hunt of Alpine. Sarah, always phenomenal. Thank you. Some big calls there on the energy front, on the tech front too, as those tech valuations confront a bond market that is really getting shaken out. Yields higher by almost 10 basis points, approaching 360 on a 10-year, approaching 4% on a 2-year, up 4 basis points to, let's round it up, 397, 398. That's America. Look at the gilt market. We're up by 19 basis points on a 2-year gilt yield to 328 on a 10-year, up by about 17. In the bond market, we're up by 13, 14 basis points on the session. Some big moves in the global bond market. We're going to be looking ahead to some bank testimony as well, with Jamie Dimon on deck in the next 24 hours or so. Sonali Basak has more. Hi, Sonali.
Hey, John, you're looking at a 14-page, single-space testimony that JP Morgan has released. Dimon will speak to lawmakers tomorrow as he meets the House. Bank CEOs will meet the Senate the next day. So what's on the agenda here? First of all, you have Jamie Dimon coming forth and saying that these stress tests and higher capital requirements on the back of them, the higher capital marks particularly, are bad for America. Remember, he has been beating this drum for a very long time. They had faced those harder stress tests, are going to be facing higher capital requirements because of those, as well as previously expected higher GSIB buffers. But, you know, there's a different thing on the set of lawmakers' minds separately. That is higher mortgages that their communities are facing. That is higher rents. That is higher cost of housing in many areas. And remember, we have seen this before from lawmakers on Capitol Hill with Dimon and his peers that worry about pay for their communities, the bankers that work in those community banks, at a time when you're seeing many other banks, not necessarily JP Morgan, but many other banks step back in terms of hiring and workforce. We saw JP Morgan most recently announce that they would also be cutting some of their workforce when it comes to their home lending business. But there are a lot of concerns on the minds of lawmakers today as these bank CEOs meet Washington. Remember, these are not the investment banks, but they are the biggest lenders to the communities in America.
Sonali, where have you been? It's been too long. Good to catch up.
Little vacation, John. I'm back in time to hit the hill, I guess.
You're allowed to get a rest, that's for sure. Sonali Basak, thank you. Coming up on this programme, Russia moving to annex the regions of Ukraine it controls.
Sometimes I'm being asked whether there is enough of weapons that we have received. And I always say that I will be able to say it was enough only after Ukraine wins.
That conversation still ahead.
Sometimes I'm being asked whether there is enough of weapons that we have received. And I always say that I will be able to say it was enough only after Ukraine wins. Until then, we will be asking for more.
The Kremlin moving to annex occupied parts of Ukraine, staging sham votes as soon as this weekend. Russia Security Council deputy head saying, quote, annexation would be irreversible and enable Russia to use all possible force and self-defense in the newly acquired territory. Team coverage starts right now with Bloomberg's AMH here in New York, Maria Tadeo in Brussels. Anne-Marie, the latest, please.
Well, what you could see right now is obviously this really undermines what is going on in Russia, and Putin really feeling like he has to give some sort of success, but make no questions about it. This would escalate the conflict. When I spoke to Dmytro Kuleba yesterday, he had said that Luhansk is the only region right now that has full Russian control, but the Ukraine still wants to continue in trying to make up some of the gains that Russia was making. Take a listen.
The next phase will be to continue liberating our territories. We will continue our counteroffensive in the east of the country. I would like to recall that since 24th of February, the only region that Russia controls in full is this Lugansk region of Ukraine. Now, we have a clear goal of depriving Russia of this control, which will send a clear message that since 24th of February, Russia literally achieved no strategic gains in Ukraine.
John, if Luhansk is the only region, an area that they have control over, Putin might feel like this is his one moment. Recognize these territories, similar to what he did in Crimea, bring them into the fold of Russia. Then they would become, in Russia's mind, in the Kremlin's mind, legal Russian territory. That means he would say to his people he has legal base case to use nuclear weapons there, potentially chemical weapons there, and also send Russian conscription soldiers there, not some of these others that they are hiring.
Maria, what's the reaction on the continent?
Well, Jonathan, we're still waiting for official reaction to this, but I can tell you some officials that I spoke with, of course, repeat the line that this is a fake referendum that the Russian Federation is now doing in retaliation, of course, for the loss and the pushback that they suffered in Kharkiv. This is an act of escalation, also of desperation from the Russian Federation to try to score a win, but also repeat potentially, if this goes ahead, that it will not be recognized. So this would not be recognized as part of the Russian Federation, and the people involved in this will be once again subject to sanctions. I think you also need to listen to the Ukrainian side here, which they say, well, the threat from Russia is not diminishing, it's going in crescendo. That proves the point that we need more weapons. I want to again remind everyone that for the Ukrainians, every part of the territory of this country belongs to Ukraine. They go back to 1991, and they say that is exactly what victory looks like. They will not accept this.
Maria, some people would see this as an escalatory step this morning. Other people might suggest that this is a Russian leader trying to bring this to a close and redefine success. Which one is it?
Look, in his mind, this may be a way to put an end to this, but he does know very well that he has been warned by the European Union, by the United States, that this has to be solved diplomatically, that for the Ukrainians, this is a red line. The Ukrainians will say this is something that we're going to fight, and we're going to fight on the battlefield. They will increase their calls now for weapons in the country. And also going back to the point that Anne-Marie mentioned, you do see a country that potentially is now shifting from a special operation. Remember, Vladimir Putin always said, these are professional soldiers. We're slow because we don't want to hurt civilians. The story on the ground is very different to now potentially going into a full war. And you always have to factor this, Jonathan. When you declare full war, the social impact and the pushback that it could have could be enormous. This is a wild card for Vladimir Putin. There can be many men in Russia who say, I just don't want to go to the front and fight. I'm not a soldier. I don't want to go.
Two of the absolute best. We're lucky to have you both. Thank you. AMH in New York City, Maria Tadeo in Brussels. Anne-Marie will be tremendously busy over the next couple of days with the President heading to New York and the UN General Assembly. Equities are down 1.23% on the S&P. We're 21 minutes into this mess. The Nasdaq is down by 1 percentage point. Yields are higher on Treasuries by 9 basis points to 358. Mentioned it a few times already this hour. It's not just Treasuries. It's Germany, it's gilts, it's pretty much everything. In the UK, the 10 years up by 16 basis points to 329. In Germany, we are now higher by 14 basis points to 194. That's the bond market. That's the equity market. Let's dig into that stock market with some sector price action. Here's Abby.
Hey, John. Well, with this bearish action, as you were just mentioning, the S&P 500 down more than 1%, having everything to do with yields being higher, that 2% yield knocking on the 4% door, up a 9th day in a row, the highest since 2007. All 11 sectors are lower and by about 1% or more. The worst sector, materials, all 28 stocks are down within that sector. This even as the commodity index is basically flat. Real estate also down about 2%. Those dividends looking less attractive as yields push higher. Consumer staples, on the other hand, that's another dividend-rich sector, but it's actually the outperforming one, down just 0.8%. And tech, interestingly enough, also outperforming. So it's sort of an interesting shift here. Over the last few weeks, though, John, as yields have simply marched higher, it has really hurt tech the most. You can see that New York FANG index, the mega cap index, that also includes a lot of China tech. It's down about 3% over the last 3 weeks. Banks at one point had been higher. They are now down ever so slightly, however.
Abby, thank you. Stocks down, yields up, dollar stronger, euro dollar 99.73. That currency pair negative 0.5%. Sterling trading weaker going into the Bank of England the day after. That decision will come the day after the Federal Reserve. Cable 113.93. Sterling down about 1/3%. Coming up, the trading diary just around the corner. A rough, tough start to Tuesday. Equities down 1% on the S&P. On the Nasdaq, we're down about 0.8%. Yields absolutely flying on Treasuries, on bonds, on gilts. A 10-year gilt up 16 basis points to 330 on a 10-year in the UK. Yields higher, stocks lower. Here's your trading diary. We begin with the President speaking at 1:45 Eastern, then heading to New York to deliver his speech at the UN General Assembly. Plus existing home sales and big bank CEOs testifying on Capitol Hill. And it's the main event, a Fed rate decision and Chairman Powell news conference, followed followed by rate decisions from the BOJ and the BOE on Thursday, and we close out a week with US PMIs on Friday. Looking forward to the Fed coverage with you. We'll kick that off in a big way tomorrow morning, live from New York. This was the Countdown to the Open. This is Bloomberg.